Hello and welcome to CMC Markets on Tuesday the 18th of June and the weekly market update. And what a last 7 days it's been. We've had an awful lot of volatility, not only in the S&P, the FTSE, the Dow Jones, but also in the Japanese Nikkei. And it's all about really stimulus and the amount of stimulus that is likely to be washing around in the system over the coming months. Now, obviously last week we saw an awful lot of volatility in the Nikkei, largely as a result of the Bank of Japan's reluctance to add to the stimulus measures that it's already embarked upon in April this year. And there is some evidence that possibly we could be seeing some pickup in economic activity. So I think the expectation that the Bank of Japan will add to its already fairly large stimulus program was slightly, I think there was a slight over expectation on the market's part that they would actually do that. And when you actually look at JGB yields, it doesn't really warrant any extra stimulus to hold yields down. They're around about 0.85% at the moment as it is. And if you compare them to where they were 5 years ago, they were 1.8% then. I think the likelihood that borrowing costs are edging up is going to be a problem at the moment is not a real concern. We also saw UK and US equity markets test some very key support levels. In the FTSE's case, 6,200. That's really the key level on the upside that needs to hold for the current uptrend to remain intact. And on the S&P 500, the 1600 level, that's a fairly key level as well. I won't show you that on the charts, but I think you guys pretty much know where it is if you were watching my weekly Monday webinar, which is actually on YouTube. You can have a look at it on there. So what I'm going to focus on this week really is Mr. Bernanke's press conference, the FOMC meeting this week. I think that's really the big event for this week, and expectations that as to whether or not Mr. Bernanke will be able to calm the feeding frenzy that's gripped markets over the past few weeks as to whether or not the Fed are going to taper, or not so much whether or not as to how fast the Fed will start tapering their current asset program. Now let's put this into the context. That are currently pumping $85 billion a month into the US economy. If they do embark upon a tapering program, it's going to be data dependent. That's pretty much been flagged for quite some time, yet the markets are getting themselves into a lather about the fact that the Fed may suddenly go cold turkey on the stimulus measures. That simply will not happen. What the Fed are likely to do over the next few months is, as the data permits, they may well decrease the amount of dollars they're pumping into the US economy, and they could decrease them by $5 or $10 billion a month, $75 billion. They are still adding stimulus to the economy. What's changed is the perception that from at the beginning of the year, when markets were thinking we're going to get QE unlimited, that's no longer on the table, and I think that's what's caused the drops that we've seen in equity markets thus far. And also that is what has caused the rise in US Treasury yields up to 2.2%, highest levels for quite some time. And the effect that that has had on dollar yen is quite significant. But first and foremost, before I look at dollar yen, I'm also going to have a look at the effect that some of the economic data that we've seen out of Europe and the expectations with respect to future European interest rates has had on euro dollar, because even though the dollar is looking to maybe find a base on the dollar index, it's still sliding against the euro, and that seems rather strange. So I'm going to look at euro dollar first and foremost. I'm going to have a brief look at the cable, and then I'm going to finish up by looking at dollar yen. So let's start with euro dollar. Now euro dollar's hit 4-month highs, just around the 134 area, despite the best efforts of Mr. Draghi et al. To basically make the case that negative deposit rates continue to remain on the table, and that the ECB will continue to do whatever it takes to save the euro. Unfortunately, those sorts of sound bites and jawboning are having less and less of an effect, and markets, I think, are taking the view that essentially negative deposit rates aren't going to happen for all the jawboning coming out of the ECB. However, we do, I think, appear to be running into a bit of a wall around about the 134 area, and this chart should give you an indication of where the key levels are. First and foremost, we've got 134.35, which is the 61.8% retracement of the entire down move from 137 to 128. But more than that, if we look at the 4-hour chart that I've got on the screen right now, we can see that there is a bit of a barrier coming in at 134. And we also have trendline support coming in from two distinct areas between 132.80 and 133.20. And I think if we do get a break below those key levels, and the oscillators on the charts do indicate that we do have scope to do that, then we could see a move back to around about 132.65 and maybe even 131.80. If we move on to the cable, and it's a similar sort of story on the cable chart, as can be seen from the daily chart that's on the screen right now. We have struggled to significantly break above the 200-day moving average around about the 157.0510 area. We have traded above it, but we've really struggled to really break that much beyond it, and really beyond the 157.80 level that I've been blogging for quite some time is a very, very key resistance level on the upside. Now, early this morning, we broke below the 156 area, and we can see that really much better on the 4-hour chart, which I'm about to display here. So as we can see on the 4-hour chart, we've broken below the 156 area, and that had acted as a significant support and was also resistance on the way higher at the end of April and the beginning of May. And as we can see from both oscillators on not only the daily chart but also the 4-hourly chart, there is potential for further losses towards the 154 area. Now, how will we get to that level? Well, I think there is certainly an awful lot of what I would call event risk with respect to the UK economy. Later this week, we've got the latest minutes from the Bank of England. I'm not really expecting too many surprises there, but what we could get in terms of retail sales is an unpleasant surprise on Thursday. And we are expecting about a 1% rebound in retail sales on Thursday after the very sharp decline that we saw in April. If those numbers disappoint, then that could throw into sharp focus maybe the lackluster nature of the UK recovery. And let's not forget the latest public finance borrowing figures later this week as well. They could also have a significant factor in terms of whether we get additional sterling weakness over the coming days. Which brings me neatly onto our dollar yen chart. Now, there's been a sharp correlation between dollar yen and the movements in the Nikkei over the past few weeks. You can virtually overlay one chart straight on top of the other. Now, we do appear to have found a bit of a short-term base on dollar yen, just below the 94 level. You may recall that 93.60 is a very key level on the dollar yen. It's the 38.2% retracement of the entire up move from the November lows to the highs earlier this year. While that remains intact, we will remain very susceptible to any short covering rallies. Having said that, we have broken below the Ichimoku cloud, and that does suggest that sentiment has shifted ever so slightly, and we do need to get back above that. However, that Ichimoku cloud resistance is all the way up around about the 97.10 area. So even at current levels, we can still go quite a bit higher. And our client sentiment at the moment on dollar yen does suggest that our clients expect it to go a bit higher. It's around about 75% long, 25% short. So there is certainly potential for us to go a little bit higher. But overall, I'm a little bit cautious given the fact that the Nikkei is struggling to get back above the 13,200 level. So I think if we can get above the 13,200 level on the Nikkei, then we could well see further movements higher in dollar yen. Until such times as that happens, then I think dollar yen could well be capped on the top side. Okay, so that's it for this week. Just a quick reminder that on Wednesday at 6:30 I will be doing a client webinar, trading the FX patterns. Starting at 6:30, we will be overlapping the FOMC, so we may break away briefly to cover some of that and hear what Mr. Bernanke has to say about his expectations for the US economy growth forecast for the US economy. That could well give clues as to the timeline of further Fed tapering, or any Fed tapering, if you like. So tune in tomorrow. Otherwise, I will see you all this time next week for the next market update. Thanks very much for listening. This is Michael Hewson talking to you from CMC Markets.